All right, everyone. So it's going to be a big year in the markets this year, trading the euro. So I'm looking at trading the euro against the Japanese yen because of the market's expectation that the European Central Bank is going to be cutting interest rates in 2024, while the Japanese Central Bank is expected to start raising interest rates. So I'm going to show you how the interest rate markets drive the currency markets. You'll understand how to track central banks. I'm going to show you the spreadsheet that I use to understand when the markets are expecting interest rate changes, and it'll really help you understand currency trading. So hopefully you take this trade and you make money. All right, everyone. So we're going to have a look at the euro and how I'm trading the euro in 2024 based on the market's expectations for interest rate cuts by the European Central Bank, which is highly likely to cause the currency to weaken in 2024. So it's going to be an interesting time trading the currency against specific exchange rates. So I'm going to break down looking at the euro against like the Japanese yen, the Aussie dollar, the Canadian dollar, the US dollar, for an example, and getting trade ideas based on the macroeconomics and the fundamentals driving the currency. I'd also like to hear from you guys about your strategy on trading the euro. How are you forecasting where the euro is going? What are you using? Are you using fundamentals? Are you using price action? Are you using technical analysis? Before the video starts, all I want you to do, go into the comments and tell me just your strategy that you've been using so far. And by the end of the video, I'd like you to come back again and tell me, shit, maybe I'll follow your strategy when I'm trading the euro, because interest rates, the bond markets, the key drivers for the currency markets, if that's not been your strategy. And I'll prove to you when we go through this short video, okay? Again, please like, comment, and subscribe on this video. So let's dive in. All right, so looking at the euro, we can see from this Bloomberg articles, the markets are betting on lower interest rates by the ECB, the European Central Bank, okay? Euro falls because traders pin hopes on early ECB rate cuts. But realize how it says euro falls, because this is going to be key when we're trading the euro in 2024. The reason being, okay, at this moment in time, the markets are betting that the European Central Bank is going to take interest rates down from around 4% to around, by the end of the year, 2.5%. So there's 1.5% interest rate cuts priced in by the markets. And this spreadsheet is how we can calculate meeting by meeting where the interest rates are going in Europe. Very key for trading currencies, okay? And the fundamental reason behind that is because inflation is falling in Europe, okay? We know that during 2022 going into 2023, the euro got very strong. Look, against the Japanese yen, the euro went up around 30%, okay? The euro against the Aussie dollar during that same period of time, again, we saw strong gains in the euro. It went up around 20%. Euro Canadian dollar went up around 16%. Euro New Zealand dollar during that same period of time went up around 17%. And against the US dollar, when the Federal Reserve was predicted to start cutting rates in October 2022, that's when we started to see the euro go up against the dollar. And I'll explain that because it's more of a dollar story with the euro going up than a euro story. So there's different moves in different exchange rates, and I'll break it down for you fundamentally. Okay, so why did the euro go up against all these currencies from 2022? Well, remember at that time, inflation in Europe was way out of control. The European Central Bank had to do something. They started raising interest rates. Okay, now tell me, did you guys trade the euro in 2022 during 2023? Because the interest rates, I did. I made some amazing trades. I'd love to hear from you guys. Let me know. So let me know in the comments below if you did trade the euro during interest rate increases. But look, we can just have a look at why the central bank was doing that. And it was quite clear. At that time, inflation in Europe was pretty much out of control. By around June 2022, inflation was at 8%. We all know why. We had the pandemic, which caused prices to go up. Then the war in Ukraine caused energy prices to go up, and inflation all over Europe and all over the world was just out of control. Central banks had to do something. So they're going to raise interest rates, and you know what effect that has on the markets. Credit card payments go up, student loan payments go up, mortgage payments go up, car loan payments go up, personal loan payments go up, company payments go up on debt that we've borrowed. And we all know that reduces spending because people just don't have as much disposable income. And that's how central banks get inflation down, because when people cut back on spending, what happens? Businesses start earning less income, and all those people that they've been hiring, they're likely to start letting them go because they're not making as much money. And then there's more room for businesses to cut their prices to attract people back so they can make more money. And that's how you get prices to come down. That's why the central bank in Europe started raising rates around June in 2022. It was at zero for a very long time. And then they started to raise rates at a 0.5% increments, which is out of the norm. They usually raise rates slowly in quarter point increases, but it was 0.5%, and it rapidly got up to 4.5%. Okay, so look, you can see it was around June times they started to raise rates, and you can see the euro started to really appreciate in value around June times. Okay, so you can see around this period of time here, June, July time, this is when the euro started to take off. Okay, we've been trading sideways for a time, but we really started to see the currency pair really kick off around that same period of time against the Japanese yen. For a prime example, we saw the euro take off against the Aussie dollar around the same time, July, June times against the Aussie dollar, same against the New Zealand dollar, for an example. Okay, around these June times over here, the currency pair took off and we went on a really good trend. Okay, so why did interest rates cause the euro to go up in value? Well, it's really simple. If you're looking at interest rates, you can understand that when the bond market is pricing in higher interest rates, you can see here, look, you can see when rates are going up from around June, okay, and the markets were already betting on higher interest rates a bit earlier than that, because by the time June came, as I showed you over here, inflation was already very high. So even like January is already at 5%. By April it was at 7.4%. At June it was 8%, but the markets are always going to price in rate cuts, hikes, before the central bank does, because they can see what's happening. And remember, central bank has a mandate: high inflation, steady inflation at 2% and maximum employment. So as the markets price in these rate increases by the central bank, as you can see by the 10-year government bond interest rate in Germany, which is the benchmark for Europe, you can see at exactly the same time, look on the right hand side as the interest rate on 10-year government bonds go up in Europe. Look at the euro. Can you see when the interest rate starts to take off on government bonds here? That's when the euro starts to take off. Okay, look, the moment you have a period of time where the bond yields fall here, look at the left hand side of our chart. That's when the euro weakens here. And then as soon as the bond market takes off again, the euro starts to take off again. Okay, and look here, when the bond market starts to go down again, look at the euro here. It starts to weaken again. So did you guys even know this is what drives the currency markets? Let me know in the comments below. The bond market is everything you need to understand about trading a currency. And notice, when the bond market hit a peak here in October, that's when the euro peaked. Hasn't gone higher since then against the New Zealand dollar. The euro hasn't gone higher since then against the Japanese yen. Look, it peaked at exactly the same time. The euro hasn't gone higher against the Canadian dollar. It's peaked at around exactly the same time. Look over here. No more highs for the euro, because at the moment, interest rates on government bonds are now starting to go down, because as I said, the markets are pricing in rate cuts in Europe. Okay, so remember, as markets were pricing in interest rate increases, the bond market was going up in terms of interest rates, the euro was following. Why would that happen? Well, there's something really important in the currency markets called the carry trade. Now, if you understand the carry trade, it's a game changer. Okay, I'll do a brief video for you just so you can understand, but I've got another in-depth video coming on interest rates, and you should really watch that if you really want to understand how to trade the market. So let's say interest rates in Europe were at 0%. Now, as I'm sure you guys are aware, when you're trading currencies, this is the interest rate differential. That means when you're trading in your broker's trading account, euro against the Japanese yen, whichever way you're trading the currency pair is going to mean you're making money every day you hold that trade open by getting swap interest payments paid into your account by the broker. Or if you take the trade in the wrong direction, you could be losing money every day. And a lot of you probably didn't even know that. Let me know in the comments below if you're aware of the carry trade. How does it work? Okay, so interest rates in Japan have remained at 0.1% for a very long time. Interest rates in Europe before June were at 0%. So at that time, if I sold the Japanese yen to buy the euro, if I'm buying euro JPY, because you have to sell the yen to buy the euro to trade that exchange rate, I pay no interest on the yen that I borrow, and I get paid no interest on the euros that I purchase, right? So I'm not really going to make that much money. I'll make 0.1% interest over 365 days, right? But look what happens as the interest rate goes up in Europe. When it's 1%, I'm now making 1.1% interest. When it's 2%, I'm making 2.1% interest per year. 3%, and now it's at 4%. If you're a hedge fund or you're a big fund trading a lot of money, now you're pulling in 10 grand a year, free interest just on the interest every day you hold that trade open over 365 days. You're getting that free money into your trading account. If I sold the euro and bought the yen, I'll be charged 4% interest. So money's been taken out of my trading account every day I hold that trade open, and I'm not getting any interest on the Japanese yen that I buy because interest rates in Japan are at 0. So automatically you'll be losing 11 grand a year holding that trade open. Can you see now why when the euro JPY exchange rate goes up by 30%, it's because of the smart money, the hedge funds, the investment banks, the institutional traders. They understand they're chasing the carry trade. They want to be selling the yen and buying the euro because they want this money being credited into their account. Now imagine, for an example, guys, you are a massive fund, okay? Now imagine you are trading. Imagine you are trading the markets, guys, with these type of positions, with 1,000 lots, which is what hedge funds do. They're big billion-dollar funds. Now imagine you're making 100 grand a year in free interest credited into your account over 365 days. 100 grand. Just even if the exchange rate doesn't move, you still get paid that money. Did you guys know that about the carry trade? This is why interest rates drive the markets, okay? Because everyone's chasing that return. And then imagine you then make a 30% appreciation in the currency as it goes up from the bottom to the top. Or let's say when interest rates went up since June, we looked at around this time, you would have made 20%. So imagine you're making a 20% appreciation in your trade and you're getting paid that 100 grand free credit into your account. That's big money being made in the markets, right? That's why as interest rates go up, currency pairs follow. And then you can look at the bond market side. As interest rates go up in Europe, what do you think Japanese investors are going to do? They can't get any interest on their Japanese government bonds. They're going to go and buy where? European government bonds that are paying a lot more interest, okay? Because investors, if they don't want to buy currency pairs and do speculative trades, they don't invest in stocks, they don't invest in crypto, they don't take gambling in gold, for an example, in commodities, you buy government bonds, the safest security. Hence why, if I show you this spreadsheet here, throughout history, let's have a look at interest rate differentials between the euro and many other countries. So for an example, we can take the difference between the European interest rate and New Zealand's interest rate over 2011 to 2023. The difference is basically you take the euro interest rate on a 10-year government bond and you minus the New Zealand interest rate from it, and the difference is showing you who has a higher interest rate. If it's below 0, New Zealand is paying more interest on their government bonds than New Zealand. If it's above 0, then Europe is paying more interest. Europe has never paid more interest than the New Zealand dollar. But look at what happens as the interest rate differential either favors New Zealand's interest rates or it kind of narrows and it's not favoring as much as it previously was. Let's have a look. Look at this period here. New Zealand's interest rate goes from 2% premium over Europe to now 3.1%, 3.2%. Look how much the euro weakens against the New Zealand dollar. And as soon as the difference now goes in Europe's favor over here, what happens? The euro goes up in value against the New Zealand dollar. Can you see? And then as soon as the difference comes back down in New Zealand's favor, look what happens. The New Zealand dollar starts to strengthen against the euro. It goes back in New Zealand's favor for all this period of time. Sorry, the euro's favor during this period of time, 2016, 2020. What happens? The euro goes up against the New Zealand dollar during this whole entire period of time. Then we get a period where it goes in the New Zealand dollar's favor. No surprise, the New Zealand dollar strengthens against the euro during the whole entire period of time. Until recently, when the European interest rates are going up, so did euro New Zealand dollar. Did you guys know that about bond markets? The bond markets drive the currency markets because you got pension funds, you got insurance companies that are not allowed to gamble their money, but they have to buy secure investments. Bonds are the safest place to park your money. Let me know in the videos below. Here's, look, the same thing you're looking at with the euro against the Aussie dollar. Look, the interest rate differential drives the currency pair. Look, here's the currency pair, here's the interest rate differentials. Mirror image. Same thing here with the Canadian dollar, although the oil price does affect the Canadian dollar, so it's not so apparent when you're looking at the difference. Then you got the euro against the US dollar. I do actually have another spreadsheet to show you in terms of the yen, because the yen is a really important one to have a look at. Okay, because we're going to be focused on that currency in this video. So let's go over here. Let's go and have a look at the JPY. And look, we can see over here Where are we? Where's Euro JPY? Here we go. Look at the difference between Europe and JPY. They move in line with each other. Okay, so what I was just showing you for Euro JPY is, as interest rates in Europe were going up, obviously we already understand that interest rate difference is causing investors to get paid more interest into their trading account every day they hold that trade open, and that's why the euro was going up against the Japanese yen. The overnight carry and the bond market, the two main reasons. Now we're coming into a period where investors, the euro's falling because markets are pinning hopes on ECB rate cuts. So what do you think is going to happen? If you're a trader and you've been holding this trade because you're getting all this interest into your trading account right now over 365 days, you're making 100 grand a year without even touching anything, even if the exchange rate doesn't even move a single pip, you're still making that money. But what happens if interest rates in Europe start to go down? So remember, markets are predicting that rates are going to go down by 1.5%. Well, let's have a look at investors' returns for this overnight carry if they go down by 1.5%. So if rates go from 4% to 2.5, let's have a look at how much you're going to be getting on that trade. Let's take it down to 2.5. So you're going to go from $118,000 a year to now $75,000 a year in free money. It's still free money, but what do you think traders are going to do? They're going to get the fuck out that trade straight away because they know that not everyone's chasing that trade anymore. It's reached a peak. Hence why when interest rates reach a peak, the currency pairs no longer rally anymore. So whenever you're looking at trends in markets, if interest rates keep going higher and markets are still predicting more and more rate hikes to come, the currency pair will keep grinding higher because all the traders around the world understand about the overnight carry trade. They're going to put that money in that trade and they're going to get that free interest. Easy money for them. But the moment that interest rate goes lower, they're going to cash out quickly because you're going to see the currency pair could easily drop from this 20% move down to this 12% move. You would rather lock in the profits at 20% than lose an extra 8% on your trade. Does that make sense? Okay, so the markets are predicting on rate cuts by the European Central Bank. That's what's going to drive the euro. So we already know that the markets are betting on rate cuts in Europe, but interestingly enough, the markets are also for the first time in a very, very long time in Japan betting on rate increases in Japan over the next 3-4 years, which will be very interesting because if, for an example, rates are going to go down in Europe, but now they're going to go up in Japan, you see that 75,000, that's going to go down even more to 60. So now you can trade the opposite way, even though if you're selling the euro and buying the yen, you're not going to be making money every day you hold that trade open. You'll still be losing money. Okay, let's take a one lot position as an example, 100,000 units. Okay, you guys probably trade that. Okay, you may be losing $60 a year. However, if that currency pair goes down 10-12%, you're more going to make that back. Okay, so that's why for trading the euro against the yen, there's going to be bigger moves than other currencies, because the reason the euro went up against the yen by 20-30% from this period of time here, so we're looking at March, it went up 30% against the yen. However, the euro didn't manage to go up by 30% against the Aussie dollar during that same period of time. It only managed to go up against the Aussie dollar, okay, during that same period of time by 18%, against the New Zealand dollar during that same period of time by 17%, the Canadian dollar only by 16%, the US dollar by 18%. So why? Why is that? Well, it's all down to the difference in interest rates. Europe's interest rate is not that much higher. Sorry, the other countries are not that much higher than Europe. Okay, so look, interest rates in the US, 5.5%. Interest rates in Australia, 4%, same as Europe. Interest rates in New Zealand, 4.75%. So because there's not a wide difference in interest rates, you don't get exacerbated moves. The bigger the difference in interest rates, the bigger the move. That's why you got such big moves in the euro against the yen, less so euro against these currencies. So as the markets have been predicting rate cuts in the US, yes, the euro may go up in value against the dollar because of interest rate cuts in the United States. Okay, there's a whole nother video I'm going to do on that. But you basically want to line up trades where you can see the euro weakening considerably because the interest rate difference is going to massively decrease compared to other countries. So look, the markets are not betting on that much rate cuts for the Australian Central Bank in 2023. They are betting on sharp rate cuts by the Bank of England. They are betting on small rate cuts by the RBNZ, which is the New Zealand Central Bank. Not that much rate cuts in the Bank of Canada. So you could sell the euro against these currencies. Okay? I don't know why I keep getting that wrong when I type in the Aussie dollar. All right, guys. So look, we could be looking at euro Aussie dollar to go down in value. Euro New Zealand dollar to go down in value. Okay, for example, euro Canadian dollar to go down in value, which already started happening already. Okay, they're the ones we want to be catching because look, when the bond market started to go down in Europe, we've already been seeing during this period of time here of this decline, the euro is going down already against some of these currencies here. Look, against the Canadian dollar as an example. All right, these are the pairs you want to be lining up. They're the best trades you can take. All right, guys. So that's the key. Look, again, look how much the euro has gone down since the bond yields started to decline in Europe against the Aussie dollar. Same thing against the New Zealand dollar. Okay, and if these central banks are not going to be cutting rates at the same rate as Europe, we can bet that the euro is going to go down in value. So these are the best trades to take. And I've been taking these trades with my members all the time, and we're making some really good returns in the markets. Okay, so these are the kind of trades you want to be taking when we're getting into the markets. Okay, and I just had some members sending me screenshots of their profits. This member, look, 6,000 profits. She sent me this today, January the 31st. Bitcoin trade that I shared with the members. Pound JPY, S&P 500, USD JPY. Amazing results. I'm super pleased for that member. Okay, and the results speak for themselves from other members. This member made £990 following the Bitcoin trades on the 29th of January. So come and join a 30-day trial. I've had thousands of members trading me all over the world. Macroeconomics, fundamentals, understanding what's going on. Okay, guys, if you like this video and you'd like to come and join a membership team, click the links below, message me on Telegram. But look, the euro's moving. Get involved. Don't miss out. And start trading fundamentals. You need to be looking at economies and understanding what's going on, okay? Because we need to be looking at, for an example, okay, we're betting that interest rates are going down in Europe, okay? We've already established that looking at these interest rate expectations. What's the economy in Europe looking like right now? Well, we can see when 2023 in Europe, okay, inflation was coming down to 2.4%, from 5% down to 3.6%. Makes sense. Inflation's on its way down. The ECB is forecasting for inflation to go in the next year in 2024 from 2023 to 5.6 to 3.2 down to 2.1 by 2025. Inflation's on its way down. So you can kind of see why the markets are predicting rate cuts, okay? And it all feeds into the story of lower rates. And when you look at Bloomberg and it's telling you why the markets are betting on rate for a weaker euro because of rate cuts, now you know how to trade the currency. Very key, guys. All right, come get involved. Please like, comment, and subscribe. And I'll see you in the VIP channels.